I'm going to show you the exact strategy that I use to get 90+% win rates. This works extremely consistently, and we do not need to guess direction. We don't care whether the market goes up, down, sideways. We're going to make money most of the time, no matter what. And this is exactly how to do it, step by step. So you need to find something to trade first, and we don't actually care what it is that we trade. We are product indifferent. I'm just going to use futures. You can use equities, futures, whatever you like. It doesn't matter. But there are some things that we need to pay attention to. So once you have got your watch list up of, things that you may potentially look to trade, you want to make sure you have IV rank or IVR on your watch list and order everything from high to low on your watch list. If you're not using futures and using equities, make sure that everything is pretty liquid. Anything that's not liquid, we don't want to trade it. So high IVR or a high IV environment, and we want it to be liquid. So those are the two things. Now, in this example, I'm going to go with natural gas. I really like trading natural gas. You can typically get good returns on our capital with natural gas most of the time. It's got an IV rank of 42.3, an absolute IV level of 57%. So when we are looking at IV ranks, you only want to look at things to trade that have an IV rank of over 30. Okay, anything over 30 is high, over 50 is very high. Anything under 30 is no good to us. So once you've selected your underlying, you want to go over to where you can see a list of option expiration dates for that particular underlying. Now, we are going to be writing options contracts. We're going to be short options contracts. This is going to be very important in just a second. But for right now, we need to pick an expiration date. We want to pick one that's between 30 and 60 days out in time. Okay. Now, there is one here, 29 days and 61 days. So you could go either or. There's no right or wrong. I'm just going to go a little further out, go to May 27th, which is 61 days out. We're going to open that up so that we can see the options chain here. Now, very quickly, we have calls on the left, puts on the right, and we simply want to sell one call and one put. That's it. It's super simple, very straightforward, okay? Now, when you are short an options contract, or better yet, let's pretend that we are long an options contract, because that's what most people do. They buy options contracts. They want to turn a small amount of money into a large amount of money. Okay, so let's say, for example, in this instance, you think that the price of natural gas is going to go up to 5, right? You might want to buy this contract here, the 4.2 strike. You might want to buy that. It's going to cost you $3,100. But if price goes, above 4.5 here, as you can see, you'll start making money just above this 4.5 level here, where this green bar starts. Once you get into this territory here, you're making money, okay? But if you look at your POP, you have a POP, which is probability of profit. That's your probability of making at least 1 penny on the trade. It's 20%. So what we're going to be doing is we're going to actually take the other side of the trade, and we're going to be selling the contract. So the opposite is now true. So now we have a POP of 80%, okay? We have a POP of 80%. And in the instance where we were long the contract, we would need price to move considerably higher than where it is right now, which is why your probability of success is so low. If price goes lower, you lose. If price stays where it is, you lose. If price goes higher but not high enough, you lose. Okay? When you are short the contract, it's the inverse. So if price goes lower, you win. If price stays where it is, you win. If price goes higher but not above this area here, 4.5, you win. So you got a lot more win conditions, and that's clearly reflected in your probability of profit here, which is sitting at 80%. Now, the title of this video says 90%, and the reason why it says 90% is because we're not actually going to be holding on to this position all the way to expiration. So your POP for holding for 61 days, which is the length of this contract, is 80%. But if we want to get out 50% of max profit, then it's the number's normally displayed by this P50 number here. For futures, it's not displayed, but for equities, it is. But basically, your P50 is going to be 10 to 15% higher than your POP in almost every case. So your P50 in this instance is going to be about 90 to 95%, right? That's on this one specific trade. However, this isn't actually the complete setup yet. I'm just showing you the reason why we short or sell contracts as opposed to buying contracts. I hope that has become clear in this example. So let's actually now craft the position. So what we want to do is, now that we understand that we want price to stay away from our contracts, we're going to use the expected move, which is this vertical orange bar here. And if your broker doesn't show that, then it will also be in parentheses. As you can see here, it's plus or minus 0.76 in this case. So you can manually work it out, but with this broker, tastytrade, we can visually see it. So if we want price to stay away from our contracts and we know what the expected move is, then all we need to do is sell outside of the expected move, and we're going to get a high probability of success. So the further out you go, the higher your probability of success will be, but the lower your return on capital will be because you're taking less risk. So I like to be around 15 to 20 deltas. So you want to make sure you have delta on your options chain. We're just going to sell this here at the 20 delta, this contract, the 5.15 strike. And we're going to do the same thing on the put side at the 20 delta, 3.5 strike. So now if you have a look, what we've done is we've created a range for ourselves, okay, between 3.5 and 5.15, okay, and we want price to stay within this range. As you can see, we have a pop of 81%. Our P50 is going to be 90+%. This is where our 90+% win rate comes from. We are going to collect $2,000 up front entering this trade, and our broker is going to require basically the exact same amount of buying power to open this trade, which is $2,040. So $2,030, $2,040 in premium profit that we collect, $2,043 in buying power. So we're getting a 100% return on our capital with a 80-90% plus win rate, and that's in 61 days time. Okay, that's not over the year, that's in 61 days. This is one position, and you want to do this over and over and over again, have as many occurrences as possible to eliminate any short-term variance. But because you have such a high win rate, you are going to end up with a very nice and smooth P&L curve. The only thing you need to keep in check is your buying power requirement, and in order to figure that out, we have created a free position sizing template. The link will be in the description. The way it works is you enter in the size of your portfolio. So say if it was 25,000, you enter that, and then you enter in the VIX level. So say if it was 19.2, and then everything is going to be calculated for you automatically. All you need to do is use this information to form the backbone of your portfolio, and you'll be absolutely fine over the long run. If you would like to learn in more detail about what we do and how we do it, click on EDS Premium. Get yourself signed up. The link for that will also be in the description. Once you are inside, you'll have exclusive access to this exact portfolio that I showed you in this video. You'll be able to see the positions that we place, how we manage risk, how we make adjustments, etc. You can use that information to reverse engineer and study, or you can copy us. It's up to you. There's also a full course, so no prior knowledge is required. It's a private community, so if you get stuck, you can speak with myself, you can speak with other like-minded individuals. There's a 100% money-back guarantee as well. So once you have been through the course, followed some of our trades, and been inside for at least 6 months, if at that point you are not profitable for any reason, we will just work with you for free until you are, or you can request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing, but once you're in, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill. And once you've learned it, no one can ever take it away from you. It's a very, very powerful thing to know and to learn. And we aim to get you to that point of where you are self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.